Hey everyone, Jonathan Wu here from SWU Openinvest with our May 2023 updates. From an economic perspective, the China recovery continues to be quite strong, and in Q1 2023, GDP growth actually surprised on the upside at 4.5%. Retail sales also has been strong, and most sectors of the service economy are now performing above pre-COVID levels. Over in the United States, US rate rises are starting to peak. If we consider this statistically based on past evidence, US share markets fall as rates also start to fall. There are signs that the US economy is actually quite weak despite the ongoing tight labor market. One explanation for this can be based on the fact that a lot of baby boomers, those born after World War II, are now retired, but there are not enough Gen X, Gen Y, and Zs to actually take up their place, and hence the economy is weak, but unemployment remains quite low, and this can be said also of Australia. In saying this, we've been also monitoring the 2-year US Treasury yield curve, and it shows us that it is currently pricing in that by mid-2024, there'll be around 200 basis points or 2% of rate cuts heading into that direction. Meanwhile, in Australia, the Governor of the Reserve Bank, Philip Lowe, is likely to finish up his 7-year term at the end of September, and there is a chance that he will hike rates once more to 4.1% to make sure inflation is put to bed by the time that he finishes office. This will also allow the next governor to have ammunition to cut rates if we should hit a recession into 2024. The broader Australian economy, though, is a tale of two cities. On the one hand, Qantas just released its results and forecasts that domestic travel for the June quarter 2023 will be at around 120% of pre-COVID levels based on their current booking volume. Leisure travellers have also almost hit their pre-COVID levels. On the other hand, TV advertising overall for the first quarter of 2023 has contracted around 12%, representing the fact that companies are now starting to tighten their belts in the midst of a weakening macro backdrop. Furthermore, there are some job ad data that we've seen from SEEK that is suggesting that job ads are actually falling, and this reflects again corporate mentality, and that over time what you see is that corporates will actually stop hiring before they start completing restructures to let people go. So in a relatively high interest rate environment compared to the last decade, income-focused strategies, including ones from the private debt market as well as first mortgages, are showing attractive real yields even after taking into account inflation. Now, inflation may look to fall over the medium term, and if that is the case, interest rates, if we hit a recession, will also fall, and this will be reflected. But overall, the spread that we're currently seeing between inflation as well as real yields, as well as the actual income generated from these private debt and first mortgage opportunities, are very attractive to investors. For the month of April 2023, the Growth Engines portfolio performed net of fees 1.46% positive, and over 3 months it's down 1.53%, and over 6 months it's now positive 6.49% net of fees. The investment committee has come to the conclusion that the portfolio is well diversified and reflects our current views, and has decided to maintain that portfolio.